What's going on, everybody? It's Brian Trippe. Welcome back to another episode of the Real Estate Investing Live podcast, where we interview the very best real estate investors, entrepreneurs, and business leaders all throughout the country. And today, I'm honored to be joined by the Landlord Coach, Mr. Mark Dolfini. How's it going today, Mark?
It's going great, brother. It's good to see you.
Great to see you. We've connected for a few years now, and glad to finally have you on the show. We tried to do this a couple months back, but I wanted to make sure I had in my hands this book right here, and I wanted to go through it first myself so that I could just ask you better questions.
Sure.
And that's just kind of how I've done things, how I've operated. And guys, as I go through this book right here, The Time Wealthy Investor, it's so thorough on how to be a landlord. And that's what we're going to be talking about today, is how we've bought some rental properties and now we need to understand how to be a landlord. Because, Mark, there are a lot of pitfalls. There are even people buy rental properties and don't make any money. People buy rental properties and end up losing their shirts because they don't understand the management piece of it, which is a lot of what you're talking about here. Is it's kind of after the fact. After we've bought the property, now what is kind of what we're going to be talking about today. Mark, in your opinion, what do you see? And I want to get right on into it.
Yeah.
What do you see as the biggest mistakes amateur landlords make? When I say amateur, I'm talking about people that haven't been in the business very long. Maybe they have less than 5 properties, maybe whatever it might be. A lot of us have 50 plus properties and are still consider ourselves to be amateurs. Right. But what are the biggest mistakes that you see, because you coach people all over the country, that amateur landlords are making right now?
They don't value their time going into it. That's an easy one, because that's what I see.
What does that mean?
You described the book really, really well. But I would put a comma after how to be a landlord, but I would also say, and not spend all your time doing it, right? Because for those of you who know the BRRRR method is a fantastic method for accumulating properties. But the weakness in the BRRRR method is it stops at creating a business. So it's great for building a portfolio, but it stops short of actually building a business. And that's what the VIP method does in the Time Wealthy Investor 2.0. So when I'm seeing people getting into rental properties and, they're doing all their spreadsheet calculations and everything else, and I look at their, I'm looking at their numbers and I'm like, okay, so, they're using very round numbers. Generally, they're using, I'll put 10% for management and this, and even if they don't put management in there, they say, well, I'm going to manage it, so there is no management percentage. Mm-hmm. Well, hold on. Are you doing this for free, or are you doing this? What's the point of doing this? You should be paying yourself. You should be compensating yourself for this, even if you are the manager. So what I see oftentimes is that people are not valuing their free time highly enough, because they're just going to do it when they have time. Mm-hmm. And as a result, they end up creating not just one miserable job for themselves, but hundreds of little miserable jobs for themselves that no one person is skilled at that number of jobs. They're just not. And if they think they are, they're kidding themselves. So that's really where a lot of people get upside down.
So kind of what I hear you saying between the lines a little bit is, well, let's just talk about property management first. It sounds to me like that's going to be the bigger topic, because when I hear people sit here talking about their time, it's now I'm guilty of this. I'm going to speak for myself, but most coaches, I'm a real estate coach. Most coaches are going to say, make sure you get a property manager. You don't want to do that. You don't want to be managing property. And I kind of stop it right there. That's not the end though. Like when it talks about, you correct me if I'm wrong, like what should I be doing as a coach, and what should people who have property be doing if they get a property manager? They seem to like them. They seem to be a good property manager. Can they be hands off now and I can get all my time back?
Well, here's the problem. So I am a property manager, so I can say this. And I also coach a fair number of property managers in their businesses. Many of them are terrible at what they do. And the problem is because they have no infrastructure and process, which is the system part of the VIP method. So because they're terrible at what they do, they have one person that's basically worked to death, and they have lots of weaknesses in their system, and many of them are terrible at one thing. Now, anytime you have a dearth of infrastructure or process, anytime you have a lack of infrastructure or process, it shows up in one way, and it always shows up in this one way is poor communication. So every single time I have a property management client that comes to me that says, well, I'm really, want to come with you guys. I'm like, well, what's wrong with your current situation? Do you have a property manager now? Without fail, if that's not the first or second reason, it's, well, that I don't communicate. They never tell me what's going on. I never hear from them until, and that's because they've either got a lack of infrastructure or a lack of process.
So Mark, are you saying, and I want to dig into, I'm going to ask you the question, how do we find a great property manager? But let's just, before I get to that, let's say we've got a great property manager. Let's say that I know I've got one, or one's been recommended to me. I've never had issues with them. They do a great job communicating. I've got a great one.
And there's some good ones out there. Absolutely.
Okay. Let's say I've got a great one.
Right.
What else is there? As I'm an investor, I have rental property, and I've given my portfolio to a manager that I like and I trust, and they've been doing it for a while. What else is there for me to do as the investor?
Right. And I can tell you the worst kind of client for me in the property management business is one that's not engaged. That is literally the worst, because
but don't we want to not be engaged though?
I'm telling you right now, it is really hard for me to manage a property effectively if I have a disengaged owner. Meaning like, okay, fine, you want to be disengaged, but understand there are real serious consequences for that. Like, you can do that for some, and I can't tell you, is it a month? Is it a week? Is it 3 months? I have no idea. But if I can't get in contact with you, I'm going to do the best I can based on the decisions that I think that I can make. And sometimes those decisions aren't always in alignment with that person's, for example, if a furnace goes out and you're not contacting me, I've created a constructive eviction with that individual, right? So in most states, if I don't follow up with fixing a property that's supposed to have heat, now it's not a big deal in Alabama, it's a huge deal in Indiana, where if it's
pretty cold here right now.
Yeah, I think we win the coldest though, compared to you guys. But right now, like even right now, I've created a constructive eviction situation where now they can move out because I've constructively evicted them and not fixed the furnace. Okay. And the furnace might need replacing.
Understand.
Right. So now I can't make an $8,000, $9,000 purchase without talking with them.
Okay. So listen, but that's not, right. I'm not talking about that though, because I'm not sitting here saying that you can't get a hold of me.
Okay.
You can get a hold of me. There's something going on.
There's plenty of owners I can't though. I'm just telling you.
I'm not saying that. I'm not saying you can't get a hold of me. You can get a hold of me, but I don't want to be, what's the word you used? Engaged. I don't like engaged to me means I'm like, I want this to be passive. And I understand that some people say there's no such thing as passive income.
Sure.
Because there's always an element of your involvement.
I would agree with that. Yeah.
So, but I want to be as passive as possible. Yeah. If I just have to make a decision here or there, sure. Great. No problem.
Right.
But I expect you, the property manager, to take care of things. And I want to kind of frame this conversation, Mark, around not necessarily you as my property manager. I want this to be a conversation about property management, but I want it to be more framed around as the investor, and I've got a rental portfolio. I want to do everything in my power to make sure that this portfolio is going to be as successful as possible with limited or minimal involvement on my part.
Right. And I think, and from that, framing it that way, because again, I think there's, like what you just described, hey, if I can get you on the phone and we can make a decision, that's great. Unfortunately, that's pretty rare, because many times people will think, and there's investors that we have that will contact and say, hey man, we've got a significant problem here. Do you want us to pay, $300 to repair this old refrigerator, or do you want us to buy a new one? it could go either way. And if we don't hear from them, right, because they're disengaged, because it's passive income, it's mailbox money, I'm using air quotes here, and we could go either way, and either way could be the wrong decision. Well, why did you spend $300 on a refrigerator when you could? Well, now they're probably closer to $700, but where you could pay $600-700 for a new one. Or why'd you buy a $600 or $700 refrigerator when you could have fixed it for $300? It's in that weird gray area that we run into, right? But to answer the question specifically, is that I find that a lot of people are underwriting their properties with the incorrect numbers in terms of what it's going to really take to manage the properties with someone else's finger in the pie. Meaning they, when they're underwriting the properties originally, now this is not covered in the Time Wealthy Investor 2.0, but I have this as a free download on my website, where the most common mistakes that people are making is when they're buying the property and they're using very round numbers in terms of capital expenditure and vacancy and management fees. They're like, well, we'll just use 5% for CapEx, which for anybody who might be listening doesn't know what capital expenditure is. It's the bigger ticket items that you may have to replace. You might, you need a CapEx allocation for roofing and HVAC and so forth. But if you can actually dial into a very specific monthly number, knowing what that capital expenditure is, because you're going to know the useful life left of those big ticket items, right? You can ask the person when you buy the property, when did you put the roof on? Well, 10 years ago. Okay, well, there's 30 years generally in a roof. It's going to be a 20-year useful life remaining. You just back into the numbers, right? And then just say, well, what's it going to cost to replace that roof? Back into the numbers, and you can come down with a monthly number for that roof, rather than just throwing a 5% of rents number, which is absolutely arbitrary. How does the rent number have anything to do with the cost of the roof? It doesn't. Totally. It doesn't have anything to do with it. So that's why I say I'm much more intentional. That's just one thing. How quickly can you turn properties, right? So when you're turning properties, when you're going from $0 to turn back to dollars, meaning someone moves out, you turn the property, and you get somebody back in, people will just throw, well, we'll put 5% on there, we'll put 10% on there. But when you look at that actually as a measurement of time, all of a sudden you go, wait a minute. So it's going to take, you put 10% on there. It's going to take 1.2 months to get this thing from $0 back to dollars. Or they put 5% on there. It's going to take, 3 weeks to go from $0 back to dollars. I mean, it's a very, when you're using percentage numbers like that, it's a very, very arbitrary measure. That's why now, if you're looking at a management company, management percentage, which a management company does charge 10% of rents, then that's an appropriate time to use the percentage amount, right? But so often I see so many people underwriting properties that way. If you're just doing a back of the napkin, okay, let's just throw some numbers together just to see if the deal is viable, I get that. But when you're really getting ready to make an offer, you've got to get really specific in terms of those numbers.
Agree. And you gave us a great example with the CapEx stuff, because we want to try to really figure out how much, which we can do, how much life is left in whatever we're not replacing on the rehab, right, if we are rehabbing on the front end.
Right.
But what about eviction rates? What about just normal maintenance costs?
Yeah.
What about, we should generally know what our taxes are going to be. We should generally know what our insurance is going to be. But as I go through the line items of expenses, maintenance is a complete unknown. Right. Eviction, or when I sit here and talk about like a vacancy rate and turnover, which I would include in the vacancy rate, it's completely, I don't know what that's going to be. What do we do?
Yeah, and there though, you do know. I mean, you can make an allocation. I mean, you can make a best case judgment, because where I'm seeing in terms of the age of a house, in certain markets, it's going to cost more with an older property and older appliances than it is with a newer property with newer appliances. It's just the nature of it. So I can get an allocation. And again, this is where if you're brand new to the business, I would much rather that you over allocate in the front end. Ask someone who's in the business if you're not real familiar with what stuff costs, because this is exactly, I mean, if you were living in your own house now, then start calling around. Start calling around in terms of, if you're not fixing stuff, if you're doing the handyman stuff yourself around your house, start making those calls now. I mean, this is a little bit more advanced for people who are not, who are just getting started. But you can still come up with an allocation, and usually, to your point, that's exactly where people underestimate vastly what it's going to cost to maintain a property, because the maintenance will eat you alive if you're not careful. And people who allocated maybe, well, I'm going to put it, I'm just going to put $100 a month on there, and then all of a sudden they're 3 times under, they get beat up. They get beat up bad.
So I ask you, what's the number one mistake you're seeing folks make?
If they're self-managing, now here's why I say if they're self-managing, but if they're not self-managing, that's why I answered it the way that I see it.
I don't want to talk about self-management right now. Right. I feel like that's a whole other ballgame.
Right. So if you have other people managing the properties for you, this right here, this whole concept of not underwriting properties properly, that's it. That's it. Probably even if they're doing self-management, or if they're having someone else do it, they're not underwriting their properties correctly. They're paying too much for them. They don't have, just to your point, I'll take a very, very simple example. Mowing expense, right? Mowing expense. Okay. And I say, well, I see you haven't allocated any money for mowing. And if it's a single family dwelling, what do they say? Oh, well, the tenants will do that. Okay, very good. I agree. Then they should. But what happens when the property is vacant? And they go, well, I'll just run over there and mow it, or whatever it is. Congratulations, you just made a mowing job for yourself. Or or in the case of the conversation of having someone else manage it, now you're going to have to pay for someone to mow that property.
That's a turnover expense, though, to me.
If as long as you've allocated for it, but many people haven't. Mm-hmm. Many people haven't, and sure. Or utilities. I'm just making this because I break all that stuff out. I want to know, like, if it's turnover, fine. I want to know what's the actual turnover cost, because some of that could be a capital expenditure item, mm-hmm. right? So not to get in the weeds on that, but I want to know specifically, in terms of utilities, why don't you have utility expense on there? Because there is going to be periods of vacancy.
Yeah.
And they've not allocated any of that stuff. So me personally, my background's in accounting, so I like to break it all out. I like to know, I mean, if it is a turnover expense, that's fine, but I still want to know what am I actually paying for?
Got it. So this is the number one, and I hear you there, and that is a big deal. Here's the number one mistake I'm seeing that newer investors, really seasoned investors, are making this mistake too. Mm-hmm. If you have one rental property, let's just start from the very beginning. Okay. I just bought my first rental property, and I have a mortgage on the property. Let's use super, super round numbers here.
Okay.
I bought it for $100,000, but I have a mortgage on it, and my mortgage payment's going to be, what is it going to be? Probably, with taxes and insurance, probably going to be $750. Maybe not that much. Maybe $650.
I'd say around $700. I mean, yeah, give or take, depending on the taxes and so forth.
My rent's $1,000. Where's the cash flow?
Yeah, you're already hit. I can tell you right now, you're hit.
So there's no cash flow there.
Right.
Let's make the numbers.
But the problem, just to clarify that point, someone who might be listening go, wait a minute, there's $300 a month in cash flow there. You're kidding yourself, because you're going to get, again, you might be, let's say, again, we're going to take out the management fee, right? Which automatically is going to take $100 off the top. Again, because it's off the top, but they don't care about your mortgage. It's going to be off the top. So now you've got 200. All right. So everything we just talked about in terms of the capital allocation, capital expenditure, your vacancies, all this stuff, everything you just described is the reason why people hate this business, is because these wild, crazy swings in cash flow, because they've not allocated this money that's set aside. Because fundamentally, they paid too much for the property. They didn't do their underwriting properly.
Well, I don't think they paid too much for that property. $100,000 property getting $1,000 rent. I feel like that's 1% rule. That's pretty normal.
Yeah, it's normal, but it's not. I mean, personally, I would rather not do the deal if it's going to be that. To me, that's too lean. I don't like properties like that. But I get it. I get why people are doing it. They're doing it for other reasons. But
Sure,
But
there's going to be some appreciation there.
Sure.
I need the tax benefit. I can't get a great deal in this market, Mark. This is the best I can do, and it's in a good area. And so I'm going forward with this purchase. But here's the point I want to make: $1,000 rent. My mortgage with my taxes and insurance is $700. So that leaves me $300 left over that I still haven't paid management. I don't know what maintenance is going to be. I don't know what turnover is going to be. I don't know what CapEx might be. There's all these unknowns. The biggest mistake I see, which we're talking about the same kinds of things, so we're in the same ballpark.
I feel like we're in the same thing
for sure. The biggest mistake I'm seeing is people take that $200 that's left over because they paid their property manager and they paid their mortgage. They have nothing else immediate to pay.
Right.
Take that $200 and they don't know how to manage that money. Mark, what should people do with that money? I'm a big believer in, I think entrepreneurs are the worst spenders. A lot of them are just spenders, and a lot of them can't plan, don't understand. How do we get that money out of our hands if that's what we need, and get it allocated somewhere and get it in something we can't? How do we solve this issue?
Yeah, I mean, let's pretend that the numbers do work, okay, and that 200 is enough to make it work. You're 100% correct that what they're not doing is they're not paying that. Let's pretend that their CapEx number, based on the future just replacing of the roof and replacing of the HVAC system. Let's just do that. Let's say that number is $60 a month. Okay. So that $60 a month goes into a CapEx account specifically. Those allocations, and that cash gets put aside in those. Let's pretend that there's 3 different buckets. Let's pretend there's a maintenance bucket, a CapEx bucket, and a vacancy bucket. Okay. And then the rest could be your profit, right? So let's pretend that that the maintenance has been, you set aside, $30 a month, which is not anywhere near enough. Just to make the numbers work though, in your situation here. So you paid your maintenance, you got $200, you got $50 set aside for CapEx, you got another $50 set aside for maintenance. So, and then you've got another $50 that you're going to set aside for vacancy, right? So you're making $50 a month after everything's paid. Let's just, in perfect world, right? So if and I will tell you, my average vacancy is about once every 3 years. But let's just pretend that you underwrote your property based on a 20 more month vacancy cycle, right? So you have that $50, which is, the math should back into, your monthly rent divided by 24. And that's the money you're putting into the account. Mm-hmm. At the end of that 24 months, when they move out, or let's pretend they don't move out, guess what happens to that money? The rest of it becomes profit. Mm-hmm. You've already paid into your vacancy, your vacancy bucket. Mm-hmm. You don't have to pay any more. You might have to bump it up a little because the rent may have increased, but because that is going to protect you from these wild, crazy swings in cash flow. That's why everybody hates this business. I mean, well, they blame the residents, but they're creating their own problems when they get these crazy swings in cash flow because they have not allocated that money properly.
And Mark, to further highlight that, people think that they're getting $200 a month and they think they've got cash flow here.
Right.
And they may have $50 or $100 of cash flow. They think they have $200 or $300. They don't. And when it comes time for something to be paid for, they don't have the money for it, or they've got to go and reach from a different account that they weren't planning on. Yep. And all this, you just said this is why people hate this business. This is why I say you can't make money with rentals. You got to have a bunch of them to make money with rentals. True or false?
No, I don't agree. I mean, I think that this is why I go back to when people are buying properties, and the only reason I can say this is because I did this wrong for years. I paid way too much for properties. I've made every mistake you can possibly make. That said, real estate is also very forgiving, but you've got to be able to weather the storm.
Yes. And
I had other streams of revenue that were able to get me through. But I'll also tell you, I'm not the guy that was born on the 3rd day of a month and called it a triple. I absolutely got this wrong to the point where I had a $6 million portfolio and lost 2/3 of it in about 8 months. So, back in 2009, I got my ass handed to me in 2009 because I did this all wrong. I was, quote unquote, making $150, sometimes $200 a unit. I had 92 units. Back of the napkin, I was bringing in $65,000 a month in revenues. Everybody was looking at me like I was some, wonder child. It was a disaster. So it
was a disaster because you didn't properly allocate the money.
I didn't. Well, I'm probably going to go a little bit more philosophical, that I didn't value my time highly enough, because if I had, I wouldn't have climbed into probably at least half of those deals because they were too thin. They were too skinny. I was buying whatever was for sale. I was literally walking into the flea market going, sure, that sweater that has a hole in the elbow and I'll never wear it, I'll buy it, sure, just because it's for sale. That's literally what I was doing. Even though the cash flow was so skinny, I was looking exactly what you just mentioned. Hey, my PITI and my mortgage payment is $700 and I'm going to be able to bring in $850. Sure, sign me up, right? And I can do it for no money down. And many people, if you've ever heard, just because you can get into a deal with no money down does not by default make it a great deal.
For sure.
Right.
You Mark, you mentioned the word forgiving. Real estate is forgiving because there are massive tax advantages to owning rental property.
Yep.
There is appreciation in a lot of cases, even I'm sitting here talking about Birmingham, Alabama right now, and some of these C- areas are even seeing some really big appreciation right now.
Right.
We're seeing so you're getting this, the principal pay down, you're not going to be paying that loan forever.
Right.
So you've got someone else theoretically paying your loan down. So there's a lot of benefits to owning rental property that makes it super duper attractive on the front end.
Right.
The problem is you don't see the benefits of all that right off the bat. You really only see cash flow right off the bat. And in some cases, that cash flow is not that much.
If it most times, especially given the situation that let's go back to your analogy here, where you have $100,000 property that you bought, $700 cash flow. That deal is skinny. I will tell you that that's probably a deal that I would really have. I probably wouldn't do it personally. Not where I'm at right now, anyway.
Unless it's if it's in a great area though, that's a really rising area, and you're looking at it from a different.
Yeah. I have all the properties I need though. That said, I still did 6 deals this summer. Even though I was saying, look, I really don't want any more, but it just kind of fell in my lap. But that said, the one thing, and this is the one thing that is great about having the hedge against inflation, is the fact that the rents are going to increase when you've got fixed pricing on your money. So that's what's going to be key to that.
When you say fixed pricing on your money, you're talking about the loan.
Correct.
The loan interest rate.
Correct. So if you got fixed price, then the only variables you're going to have, obviously, of course, are the maintenance and the taxes and insurance. There's obviously plenty of variables. But all that aside, you've got a hedge. You got a built-in hedge against inflation. It was about 6 or 7 years ago with the properties that I was able to keep in my portfolio that all of a sudden it was like a period of like 2 or 3 months that I was like, holy crap, I'm actually making net positive money in my rental portfolio. This is pretty cool. And as a result, I'm a deleveraging type of guy. I'm deleveraging my base portfolio right now because I don't.
What does that mean?
So like my base portfolio. Deleveraging. Yeah.
I'm thinking the letter D. Like as A, B, C, and D.
Yeah.
You're unleveraging.
Unleveraging. Yeah.
Okay. Yeah.
I'm removing my debt, paying down my debt.
Got it.
And I know that there's a lot of people right now that just think that's crazy, but I want the thing that delivers my base vision, my life and my lifestyle that I enjoy. I don't want that being tied to anything where I could potentially lose that. That's why I'm so focused on getting that paid down. Even though mathematically, does it make sense? Does it make sense to leverage my portfolio right now? Yeah, in a rising inflationary environment, getting fixed pricing at very low interest rates, it totally makes sense. Mathematically, in my brain, I can't do it. Emotionally, I just can't.
Yeah. And we've talked about that on the show before where it's really a preference thing. You know, do I pay it off or do I continue to, some people say refi till I die because that money is tax free and I'm just going to continue to refi.
Totally get it.
That is an age old debate that's probably never going to go away because there's huge benefits to both.
Yeah.
Last question I have for you before I actually start digging into some of the stuff in the book about how to actually, kind of do more of the hands-on stuff.
Yeah.
If I have a property manager, and I've kind of already asked you this, but now that we've kind of framed the conversation a little bit, a bit better, I want to come back to it. If I do have a property manager that I trust that is doing a really good job, what is there for me to do?
I mean, really, what I would do is I would just treat them just like you are a business owner. And I think that's where some people make the mistake is they forget that they're a business owner and they have a manager. Like that manager is running your business. Mm-hmm. And I would have, frequent check-ins with that. I mean, for those
to do what?
Just the reason, you're asking me a question that is outside the scope of how I'm normally answering this. So to go over the specific metrics that are going to deliver my vision for me, because again, keep in mind, the book is about vision, infrastructure, process. And the reason why, even if you have a property manager that is delivering and doing really, really well, I would still encourage you to read the book. Trust me, it's not about pushing a book that I make $0 on the book. So it's just really more about getting the information out there. But you have a much clearer understanding of how a good functioning business runs. And then you can say, okay, look, then you can start to hold them accountable to specific metrics. Because if you're not looking at your numbers, if you're not monitoring the numbers, it's not being managed well. I mean, you might think it is, but all of a sudden it's like, wait a minute, that property sat vacant for 2 months. And if you weren't paying attention, you might have only noticed a little blip in your cash flow, whereas it could have been substantially higher, right? These are the sorts of things. So, in terms of the metrics, and I mean, we can get into the weeds on that, but I don't think you do. But the thing is, what I'm saying, like, I really want to see in terms of the 4 core functions of a business, which is the marketing, lead gen, the sales, the operations, the accounting, those 4 core functions of any business. Like if you have a property management company, they're doing all four core functions of that business. Mm-hmm. They're doing your marketing and lead gen. They're doing your sales. They're doing your operations. They're doing the accounting. And you should have, in any business, you should have metrics for each of those core 4 functions.
So how do I choose my property manager then? Because I said I was going to come back to that.
Yeah.
It sounds to me like I need to find a property manager that really holds those 4 metrics, that they do those 4 things well.
Correct. Yeah. And the way, to answer that's the age old question, because I've had people after they read the book and they said, holy crap, that book was really good. Holy crap, there's no way I want to manage them on my own. I just don't want to do that. That's
why we're not going to spend the majority of the time talking about all this stuff, because I think that you recommend people to get a great property manager if they can find one, wouldn't you?
Well, it depends. It depends on the individual, because there's just some people that just don't have the ability or tolerance or time with or bandwidth to do this. Most of the people that end up working with me directly, they do want to do that because they can do it a lot cheaper and they can also do it at a much more consistent basis. Because keep in mind, it's funny, like you can go to Burger King and you can quote unquote have it your way, right? But can you really? Can you really get like a wheat bun? No, you really can't. You can only get the buns that they have. Just like, for example, I have people that come to me that want me to use their lease. I'm not going to use their lease. I won't use their lease because I have a system that's built around my lease, right? And so there's really only certain ways that you can do certain things. For example, you may get a property manager that will only collect rent on a monthly basis. Right now, if you know the math and you get someone to pay bi-weekly, meaning every other Friday, you can actually get an extra month's rent out of a course of a year, right? Because of the way the math works. And you underwrote your property with that in mind, that you're going to do it. Hey, I want to collect rent every other Friday, but you have a property manager that won't. And they may be great in every other way, right? But they're not going to do these little bumps to your revenue that they're just not. So that's why, for me personally, I like to teach people. I don't want them to be landlords. The irony about me being the landlord coach, the irony is I don't want them to be landlords. I want them to be business owners. That's what I want them to be. And ultimately, I want them to be an investor, but that's still going to take engagement. So to answer your original question, going back to how do you find a good property manager, I'd read the book. I'd read the book and understand how good property managers operate. Because I'll give you this perfect example. Brian, have you ever been to a restaurant and had bad service?
Yes.
Yeah, we've all experienced that, right? Have you ever run a restaurant?
No.
No, right? I haven't either. But we all know what the problem is. You can see this old boy over here has got 7 tables. This girl over here's got 1, and you're unfortunately the guy with the 7. You're the 7th table, and you haven't even gotten water yet. Your problem, again, let's go back to infrastructure and process. The problem is you can't communicate your order to the kitchen, right? Or to the bar where you can get drinks. You're having a communications issue. Remember what I said about infrastructure and process, right? So the infrastructure and process meant that the tables were allocated incorrectly. So this girl over here's got 1 table. This guy's over here's got 7, running around like crazy. There's obviously an infrastructure process problem. So once you understand the infrastructure and process of what a good running business is supposed to look like, it's going to be a lot easier for you to hire a property manager. Now, how do you do this? Well, once you understand what that looks like, I'll give a really easy example. Call your prospective property manager after hours, right? Call them after hours. If they're, how are the after hours calls handled? If they have a voicemail that says, oh, thanks for calling ABC Properties. If you're a tenant, go ahead and hang up and call this other number. Okay, that tells me a couple things. That tells me that their infrastructure is pretty weak. That tells me that their infrastructure is probably based on a cell phone or maybe one phone, one single point of failure, which means that if they have to hang up and call another number, that other number might probably just be tied to another cell phone. Well, here's the problem, guys. Cell phones, also called mobile phones, are mobile. They disappear. They shut off. They get lost. Sometimes you walk into the house and you leave them in your car and you forget. Well, your maintenance guy doesn't think about it. And meanwhile, your property's got 3 inches of sewage in the basement, right? It shows a lack of infrastructure right out of the gate. So these are the sorts of things. Now there's dozens of other ways to check on things, but this is exactly like, I want to know specifically how are they handling certain things? What does their infrastructure look like? They can say lots of things. Oh yeah, we do daily inspections of every property. They can say all sorts of things. But really, when you start poking at their infrastructure, how do they respond? And that's what you need to be testing.
So let's, and for the sake of time, we can't get into super big detail. You should get the book, obviously, to get the detail. Yeah. But let bullet points. Infrastructure is the first thing, and we've been talking about it. You've been mentioning that. That's one example. What else in infrastructure should we be looking at? And maybe for the folks who want to manage their own stuff, what are some things? Maybe I've only got 5 or 10 properties. What are some things I absolutely need to do from an infrastructure standpoint?
Well, the base infrastructure out of any management company, or whether you're doing your own management stuff, because again, I want you to be the owner of a management company, not necessarily, having a management company, but whatever works for you. How is this being done? So the first piece, once you get to the infrastructure piece of the book, the infrastructure piece is the first thing is property management software. What's the software look like, and what can the software do? And oftentimes the reports that come out, like, hey, can I just see a sample report in terms of what it is that, like, is some management companies do really well to use lots of different functionality of their property management software system. Many of them don't. Many of them are literally just using the bare bones of it, and some of them aren't using it at all. Some of them are using Excel spreadsheets. Some of them are trying to use QuickBooks as their property management software. I'm sorry, QuickBooks. I'm an accounting guy. Okay, my background's in accounting. QuickBooks is it's the gold standard in accounting software. It is not designed for property management. It's a horrible property management. For use as a property management software. Yet I still see many management companies trying to use it. So I want to know specifically, like, the reason why property management software systems are so much superior is because they can handle all of the multiple lines of complexity that come in from your residents, from your vendors, from the owners. And it's a one central hub where they can syndicate listings of vacant properties. They can update communications, and everything comes through that one central area. So what are they using? It's not so much what they're using, because quite frankly, you're not going to know the difference between one or the other. There's literally hundreds of property management software systems. But what does that property management software system do on your end? What is your customer experience going to be? If they just say, oh, well, we have an owner's portal, that's not fresh. That's not anything special. They've all got owner's portals. But what does the owner's portal deliver for you? What you can see in terms of open work orders, and when things are updated, communications and those sorts of things.
Mark, there's so much in this, and I'm sitting here trying to figure out what I want to cover and what I don't want to cover. And it's like overwhelming me a little bit, because there's so much great stuff in here about what to do and how to do it well.
Thanks.
Let me just, I want to try to highlight what I think are the most important things for me, because I've managed property on my own. I've managed my own property before,
sure,
and I've not done it well. And that's why I'm convinced that you need a property manager. I really, truly am. Right. But it sounds to me like I heard you say earlier that even if you are going to hire a property manager, which it sounds like you recommend, you still need to know this stuff, so you know how to communicate with your property manager. You know how to pick out a good one, because you know this information. I want to ask you about risk. You got a question, or you got a chapter in here about managing risk. But I want to specifically talk about fair housing laws.
Right.
I cite this as the number one reason why people should get a property manager. You don't want to get in that game at all. You don't want to have to understand fair housing laws, because they're different from state to state. You're not an attorney. You don't want to be picking out your residents because you don't want to violate some sort of something. Accidentally discriminate against somebody just because you didn't know any better, maybe about a dog or all of this. So that's why I'm just like, don't even mess with it. Just get the professionals.
Okay.
What would you say on this topic specifically when it comes to making sure you have the right lease that says the right things, fair housing laws? What would you say on these topics if I'm brand new and I just bought my first few properties and now I'm trying to place a tenant?
Right. So with that, I think you're 100% correct. But I also think that it's, it is, let's just face it, lawsuits are the new form of lottery. That's, you try to build something cool, someone's going to try to take it. But this is exactly why, in terms of my leasing agents, that's why I use professionals. I actually, like right now, I mean, real estate agents are having a population explosion. They're breeding like Catholic rabbits right now. And they are, I mean, and so many people are out there trying to get their name out there as a new realtor. Well, keep in mind, they are trained in fair housing, right? So realtors
are.
Yeah, absolutely. They are.
So I'm a realtor and I just took a test and it might've been one question on a test. So trained.
No, I can tell you that when I went through, I mean, again, this is 10 years ago because I'm a broker and I have my license. I mean, the fair housing was a significant part of the test. I remember that. So at least in my state, yeah, I remember it well. And again, maybe it's because I'm in the business, but the main thing in the fair housing laws, because also fair housing laws are not just national, but they're also state and local, because they may have your county may have fair housing laws that you don't know about, right? This is why I like using real estate professionals to show and lease my properties. The other reason is because I don't want to create a job for myself. I don't want to create a leasing job for myself any more than I want to create a mowing job for myself or a painting job for myself, right? So the reason why, in terms of managing that risk, is I can tell you that the real estate professionals who hold licenses, they are trained. Again, maybe they're not trained well. Maybe they're just checking the boxes and trying to get through the fair housing questions as quick as possible, and they're on their continuing ed. But I can tell you that the fair housing, they receive more of that fair housing training, just the same training that the property managers have. and it's the same thing for them. So that's why, especially if they're a fee manager, where they're managing properties, like, present for an owner, not necessarily being a location based, or you've got 300 units and that person's called the property manager, right? That's different. But yeah, they are trained, and that's why I like using them. That's why I like using new real estate agents who are trained, who are trying to get their name out there. I'll pay them. I might pay them an hourly plus commission. I might just pay them straight commission. It just depends on what it is.
But even if they mess up, though, the liability's off of you is kind of the point.
Because it, now again, this is state specific, but because I'm hiring them as a subcontractor, I mean, they're putting their license at risk. That's why I like using them, and that's why I want them to. And they know what to say, and generally I went through this a little bit in the book, but there are going to be specific questions, and there's going to be shoppers that are come out there and go, there's not any of those, I don't know, and I'm saying this tongue in cheek, so please don't send me hate mail. None of those Lutherans that live nearby, or those Catholics, right? Or, those whatever. Like, look, we rent to anybody that's qualified. That's the answer. That's always the answer.
For sure.
Yeah. So there's going to be things that people are definitely going to try to bait you into. I've been down that road a couple times, but it always fell apart because we'll just say, hey, is this a safe area? Like, I'm not sure how to answer that, because to be honest with you, I don't want to violate fair housing. I'm not trying to steer anybody. And I absolutely say those words, and they go, oh, okay. And sometimes I just know I'm being tested, because look, no one uses phraseology, in a very specific way, like they're trying to bait me into something. But still in all, that should be such a no-brainer. And I will tell you, I love that this line of questioning, because this right here is where you're right. The mom and pop buy and hold investors, they make absolutely ridiculous decisions and go, well, they had too many kids, I really don't want to rent to them. Oh my gosh, please don't ever say that out loud, ever. Don't even say it to yourself, ever, because that you are massively putting yourself at risk. So it is going to be important to know what fair housing laws are, but that's why I also use professionals.
Mark, let's end with this, and this is a weird way to end, but let's end with this, because that's a really important thing there. The truth of the matter is, I don't want a bunch of kids in my property. That is the truth.
Right.
And I don't want a bunch of pets. I don't want a bunch of dogs and cats, especially cats. I don't want that stuff in my property, but there's like new laws about emotional pets, and there's laws about how do we navigate? It's a loaded question.
Yeah.
How do we navigate the things that we don't want in our property to protect our property and still be within the law?
Well, if you're doing this with a property manager, you're not going to be able to. I mean, a property manager is going to protect their license first and foremost. So they should, like, again, we have this conversation where people say, well, I really don't want anybody with fill in the blank. And I'm like, well, I can't manage your property. I'm not going to do that. I'm not going to put my license at risk because you don't want this. But this is also why I would say to understand your client avatar and buy properties that speaks to that avatar. Again, remember where we had those 4 core functions of the business, right? So now I'm shifting over to a different business now. Okay, and this is a weird way to end. But as I'm shifting over to a different business, which would be a property acquisition business. Again, every business has 4 core functions: marketing and lead gen, sales, operations, and accounting. Those 4 core functions. So in my acquisition business, I'm going to get a really clear avatar in terms of who I want to work with. Cool. I want to work with millennials who want to live near their bar district downtown. I want to buy 1-bedroom apartments downtown, for example, right? And it's not that you might not get somebody who doesn't fit that profile specifically. Exactly.
You're targeting that by the type of property.
Just by the type of property. And there's nothing now. Again, if someone now that's your bullseye, because your bullseye. That's your avatar. That's who you. Now, if a mom with a baby comes to you, are you going to say no? No. I mean, you rent to everyone who's qualified. Right. But the point is that you've identified specifically who it is that you want to work with. And, if you don't want kids, or does it make sense for you to buy 4-bedroom houses in subdivisions that are in a really highly desirable school district? Probably not. Right. But I'm just saying that's why it's important to have your ideal client avatar already defined.
No, but I think that's a great way to end. I think that's awesome. A lot of people don't give that enough consideration, or at least don't think about that when they're sitting here trying to like figure out where they want to buy, what they want to buy. Well, I know I want to buy in this area because it's growing and appreciating, but not being more specific about some of those things. So,
about their avatar. Yeah. About their, yep.
Guys, the book is The Time Wealthy Investor 2.0. Mark, tell everybody how they can get this.
Yeah, The Time Wealthy Investor 2.0 is the updated. So if you want to send Jeff Bezos more money, you can get it on Amazon. Or if you want to get it for a lot cheaper, and I will even sign it, I will sign your name to it, which basically makes it worthless. You won't even be able to give it away at that point. But you can go look at that. Hey, Brian. So I signed it, and he can't even give that book away. So that book is basically worthless.
I have to find another Brian.
Right, exactly.
You didn't put my last name in there, did you?
No, I didn't.
Brian.
Hi Brian. Yeah, I took it out of the Hi Brian stack. So
the Hi Brian stack, but
right.
It'd have to be another real estate coach because it's super specific.
Absolutely.
So where they get it, Mark?
They can get a copy for I think it's like $8 on my website, landlordcoach.com.
Landlordcoach.com.
Yep, landlordcoach.com.
Landlordcoach.com. Guys, I'm going to put that in the show notes and in the description of the video below. Guys, make sure you show Mark some love and get this $8. If you are in real estate at all, you should be getting this book, period. I have a shelf full of books we should be reading all the time. I don't do any of my property management anymore. I have identified some great property managers where I live locally. I'm still reading this. I'm still going through stuff like this because I want to stay educated on the business, because I'm in this business. And even if you're just a property rehabber, I know a local property rehabber who's doing 100 rehabs a year, swore he'd never do rentals. Now all of a sudden he bought a 40 or 50 rental portfolio. Because you never know what's going to happen. So we want to make sure that we're on top of the industry. Mark is the best in the business at what he does. Get this $8. I mean, are you kidding me? Get this right now. Mark, thank you so much for coming on the show and sharing your knowledge, your expertise. You've been doing this for a long time, and we need more of this knowledge and expertise on our show. So thank you for coming on.
Thanks, brother. I appreciate you.
Guys, we love you. Hit subscribe. If you got any value from this whatsoever, if you're not already a subscriber, hit subscribe right now. We love you so much. We're going to see you on the next one.